Okay. So that is this incremental budgeting. We have said that it is an increment of a small amount in respect to the initial budget that has already expired. So those are the budgeting control systems that we normally experience. At that point, we can now look at types of budgets. Types of budgets. Apart from the budgetary control systems, we can now look at types of budgets. Types of budgets. So the first budget is functional budget. Functional budget. Or sometimes again called static. Static budget. So under functional budgets, these are the budgets which are being prepared on daily basis, and they include material purchases budget, material usage budget, labor cost budget, you also have sales budget, overheads budget, and many more. So those are the functional budgets. Number two, we have flexible budget. Flexible budget. Under this flexible budget, my good students, when we prepare budgets at the beginning of the period, in between the period, things may not work well due to some factors. Natural calamities, economic cycle, inflation. So therefore, we need to adjust the original budget that we had prepared at the beginning of the period. We need to adjust. We need to alter, change, so that it can reflect the current condition. And we call what? Flexible budget. Therefore, flexible budget only takes into account variable elements. Variable elements. Fixed will remain constant. You cannot adjust, for example, rent of a premise. But we have other parameters that you can adjust. Direct materials, if you had budgeted certain amount of figure, you can adjust. Labor, you can adjust. So flexible budget only tackles variable. Fixed, they will remain constant. And at that point, I normally have the flexing ratio. Flexing ratio. Flexing ratio. That is the formula on how you want to use to prepare flexible budgets. So here, flexing ratio, you take the actual activity divided by budgeted activity. Actual activity divided by budgeted activity. So that is the ratio that we're using to flex the variable parameters. Good. The third type of budget is master budget. Is master budget. Number 3, master budget. So this master budget is, we normally say it is a consolidation of income statement, whereby we have the cash budget being depicted there, and the statement of financial position. That is one we term as what? Master budget. So my good students, at this point, the only challenge is flexible budget. These functional budgets, they are not being examined under advanced MA. They are examined under management accounting, intermediate level. But when we come to advanced level, we normally look at what? Flexible budget. That is the one which is very, very, very paramount in that particular area. And that is all about topic number 6, which is budgetary control and budget control. Good. To add on that, we'll be looking at what? At variances. Under that topic per se, we'll be looking at variances. Variances, and I believe at intermediate level in management accounting, you looked at variances. So we have 5 types of variances. One is sales variance. Number 2, we have material cost variance. Number 3, labor cost variance. Number 4 is after that, number 4 is variable overheads. Variable overheads cost variance. Then number 5, fixed overhead cost variance. Those are the types of variances that we will be looking at. After that, you will be required to have what we call variance investigation. Variance investigation. Variance investigation. Deritu, Henry, how are you? Hello, Henry. I can see you have joined. Henry, are you able to get me? Is silent. So after you have conducted these variances, you need to investigate. And then at that point, we have criteria or factors to consider whether to investigate a variance or not. Like now, if you have a variance, and the variance, my good people, is either positive or negative. If you are positive, if it is positive, no, per se, if it is positive, favorable. If it is negative, unfavorable or adverse. Unfavorable or adverse. Thank you very much. Thank you very much, Henry. So we are saying a variance is either favorable or adverse. F stands for favorable, adverse stands for, A stands for adverse, that is. So therefore, to investigate a variance, you need to look at some of the factors. Maybe you have gotten a variance of 5,000, which is adverse in respect to maybe material cost. To the company is an adverse. So factors to consider whether to investigate this variance or not. One is materiality. Materiality or significance. So if a variance is material, that is the point you will investigate. And at the same time, it depends on the corporate. If the corporate is big and we have a variance of 5,000, for example, for Subcom, if there is a variance of 5,000, adverse, this is not material to that particular company. But if you consider Mama Boga, grocery, this is very, very adverse to that particular enterprise. So materiality is the factor to consider whether to investigate variance or not. Two is cost benefit. Cost benefit analysis. Cost benefit analysis. Yes, you want to investigate this particular variance of 5,000, which is adverse. Investigation comes with a cost. You give those individuals in the ground to do research on this particular variance. You have to pay them. That is a cost. At the same time, what will be the benefit that you are going to realize after investigating this particular variation? So therefore, the cost of investigation should be lower than the benefit to be derived. That's the point we mean as what? Cost-benefit analysis. If the cost of investigation is much, much higher than the benefit, then don't do that investigation. Good. Another factor is controllability. Controllability. If a variance has occurred and it is beyond your control, for example, the prices of crude oil, decision maker cannot start investigating the variance because he does not have control over that particular aspect. So therefore, you need also to do what? To measure out controllability. Another one is number 3 is variance trend. Variance trend. Trend variance. One and the same. Variance trend is also a matter to consider when you want to investigate a variance. So in that case, you need to monitor January, what was the variance that occurred, February, March, April. If it is an increasing trend, an increasing worsening trend, then you need to investigate. If there is an increase, mostly increase. You can see most of them, if you want to plot, you can see there's an increase in what? In variance from January onwards. Then you need to investigate. But if it is constant or happens to be like a wave like that, then you don't need to investigate. Are we together? Ready to? So those are the variance factors to consider when you want to conduct variance investigation. Okay. Now let's look at another one, which is called variance investigation models. Variance investigation models. Variance investigation models. So the first model is rule of thumb. Rule of thumb. Rule of thumb model. Rule of thumb model. My good students, here there is professional judgment. There is professional judgment based on rule of thumb. We, as the board of directors management, we sit down and say, if there is variance exceeding 5% of the standard cost, we will investigate. For example, we say if it is or if there is more than 5% of the material cost as a variance, you investigate. If not more than 5%, don't investigate. Or we say if there is a variance exceeding 10,000 or more, we investigate. That is our rule of thumb. Number 2, statistical control quarterly charts. Quarterly charts. So under SQC, normally abbreviated as SQC, statistical quarterly control charts, it is where we have a graph. We have a graph. And this graph, we can have the upper limit, maybe 35,000. Lower limit, maybe 20,000. And therefore, we have months, January, February, March, April, May, and so forth. And here we have the cost. So in that case, we need to plot the, if it is material in terms of kgs, the material usage in the month of January. If we consumed less than 20,000, maybe 17, we can put a dot there. We plot some graph. February, maybe it is what? It is 25 in between there. March, maybe 40 above. April, within. May, below. So you can see if you join January, February, March, like that, you have that graph. Then you can see, you can be able to advise the management in the month of the one that has gone above the upper limit and below the lower limit. Those months are the ones you are going to advise management to investigate. But the ones which are within our boundary, upper limit 35,000, lower limit 20,000, in between, we don't investigate. We don't investigate. That is statistical quarterly control charts. Number 3, another model that we normally use is cost-benefit analysis again. Number 3, cost-benefit analysis. Again, you are going to consider the benefit from the benefit from model, the variance models investigation versus the cost. If the cost is lower than the benefit, you investigate. Then the last one is number 4 is significance model. Significance model. This one now uses the concept of normal distribution curve. Normal distribution curve, whereby we have the average and the standard deviation. So you'll be having the two critical regions. If the variation that you have conducted is false on the shaded side, you investigate. But if it is on the unshaded side, you don't investigate. So those are the statistical, variance investigation models. So allow me to have a break. Allow me to have a break kindly. So our last topic, environmental management accounting. We know very well that entities do not operate in a vacuum. We operate, you open a business, we operate in the society. At that point, therefore, we must safeguard our society. Polluting the environment is not a recommendation, is not recommended. So therefore, you must find a way, as maybe, for example, maybe industrial area, Earth River, you are having that particular company which is polluting or generating external waves. You must find a way on how to safeguard the environment. So therefore, don't pollute the environment by, for example, generating some waste materials to the river. Because at the river, we also have water creatures. So that generation will affect the creatures that are within the river. So therefore, we must find a way on how to mitigate. If it is purifying, you purify. Or else you will face the penalties from the government, which we call the internal failure costs or external failure costs. So that is all about environmental management accounting. As an accountant, you must advise the management on the repercussions, the penalties, which are in respect to going against the environment. And at that point, I believe those are the topics that we will be looking at. Sometimes we can have an emerging issue. Emerging issue. For example, we have what we call just in time. Just in time. JIT. This is a model whereby you are in business, but you are not holding stock. So we have the advantages of JIT. You are in business, but there is that particular product that you are not having in what? In the stores. When the customer comes, you must ensure that the suppliers have delivered. So meaning that you must have a clear coordination or liaising with the supplier, so that when customer demands, you are able to access immediately and make a sale. So if there is no clear coordination, you will have stock out. You will have stock out, you will disappoint the customers, and the customers will disappear. That is what we call just in time. It is under inventory management. 2, we have ABC analysis, also under inventory. we have ABC analysis. This is where in the business you classify ABC, not ABA, ABC. You classify stock into three classes. Class A that has about 70% value of stock. Class B that has around 20%, and then class C, which is more or less value, 10%. So this concept was advocated by Pareto. We call Pareto's law of inventory. Pareto's law of inventory, whereby he said you can classify assets into three classes, A, B, and C. Class A, very expensive, sophisticated items in the shop or wherever you are trading. So meaning here, high security must be attached to class A items. Class B, about 20%, which is moderate or middle value. You also give middle security. Class C, less security because of their less value. So that is listed what? Pareto's law of inventory management. So those are some of the emerging issues that you may encounter. Now, my good students, there is a topic which was an oversight. There is a topic of cost estimation. And forecasting. Cost estimation and forecasting, put it as an additional topic, whereby this one you have already tackled, but the method that we'll be using is accounts analysis. We also have high-low method, the one you encountered in QA, high-low method, even in advanced, even in management accounting, you also looked at. We also have what we call a simple linear regression, or ordinary, also called ordinary least square. Ordinary least square method, which is also called linear regression, simple linear regression. Analysis, and also we have another one called industrial engineering. Industrial engineering is also another, but this does not have any computation, it's just explanation. The one that has computations is accounts analysis, high-low, and the least square method. At that point, we'll look at now evaluation. Evaluation of regression model. Evaluation of regression model, whereby after getting that particular model, for example, it is y equals a plus bx, that is regression. We need to evaluate. We need to evaluate that particular model. The areas of evaluation, one is economic plausibility. Economic plausibility, sometimes called rational. Economic rationality. Economic rationality. Two, another one, we shall look at goodness of fit test. Goodness of fit test. Then lastly is assumptions of the regression. Assumptions of the model. Assumptions of the model. Then lastly, the second last is a coefficient. Coefficient of correlation. As well as lastly, coefficient of determination. This is R in bracket, and this is R squared. So that is the one that I had an oversight in respect to the topics. The two, are we together? Good, Ruth. I can see Ruth. Ruth has shared that particular drive to past papers. Thank you, Ruth. So those are the topics. Now let's see which topic we're going to start with. Let me allow for the time remaining. Remember, it's just an introduction. It's a first class. We may not do much. We may not go into much of the details. So for me, the second meeting, and it's when we will organize ourselves abundantly. Now, allow me to look at, let me the topic I can look at for the time. Let's look at topic number 5, which is strategic performance measurement. Strategic performance measurement. Let's look at that strategic performance measurement. Then we start with the first definition, which is you can say definition of terms. Definition of terms. We have responsibility accounting. Responsibility accounting, which is RA, responsibility accounting. So you can say, you can just have a small summary. It is based on the assumption that responsibility accounting, it is based on the assumption that each person, it is based on the assumption that each person who has responsibility over revenue or cost, is a separate responsibility center, is a separate responsibility center, is a separate responsibility center, whose stewardship must be defined, measured, and reported upwards. Whose stewardship must be measured or defined per se, measured and reported upwards. Therefore, responsibility accounting personalizes. Responsibility accounting personalizes the accounting system. Personalizes the accounting system. Personalizes the accounting system. Good. So that is what we mean as what? As responsibility accounting. You must be responsible for appraisal purposes. You must be appraised based on what you are defined, measured, and accountable for. Now let's look at another one. Responsibility center. Responsibility center. Responsibility center. Responsibility center. It is a unit in an enterprise. It is a unit in an enterprise. It is a unit in an enterprise. A unit in an enterprise which the manager is responsible for. Which the manager is responsible for. A unit in an enterprise which a manager is responsible for. Which a manager is responsible for. Activities. A manager is responsible for activities, costs, and revenues, as well as investment, So it's a unit in an enterprise where a manager is responsible for the activities, revenues, costs, and even investment. It can take any of the following forms. That is responsibility center. Can take any of the following forms. The first one is cost center. A cost center. Let us define what is this particular item called cost center. You say any segment or branch in an enterprise, which the manager is responsible for, which a manager is responsible for all costs that originate. All costs. A manager is responsible for all costs that originate from that particular segment. From that particular segment. E.g. production department. So you find that in an organization, the production department, maybe photocopying or molding, that is what we call a cost center, because it does not have to sell the products directly to the external clients. It has to pass over to the sister department, which is a profit center, and that is marketing. That is the one that will sell to the external customers. Therefore, marketing department is a profit center because it will incur costs as well as bring profit. That's why it is called profit center. But manufacturing or production sector, it is totally a cost center because it does not have any external client. Are we together, honorable members?
Yes, sir.
So let's look at profit center. Profit center. It is a segment in an enterprise. It is a segment in an enterprise. It is a segment in an enterprise where managers are held responsible. Segment in an enterprise where managers are held responsible for costs as well as revenues. For costs as well as revenues. For costs as well as revenues. For costs as well as revenues that originate there. That originate there. So a manager is responsible for costs and revenues that originate in that particular profit center. They not only incur costs, meaning those profit centers, they not only incur costs, but also generate revenue. They not only incur costs, but also generate revenue. E.g., marketing department. E.g., marketing department. Now we have what we call another one, investment center. Investment center. Segment where managers are held responsible. Segment where managers are held responsible. Segment where managers are held responsible. Where managers are held responsible for costs, revenues, and investments undertaken. i.e. investments undertaken. i.e. capital employed. i.e. capital employed. So those are some terminologies that you want to know. They normally ask. They normally ask those particular definitions that we have done. Now, let's look at divisional performance measures. Divisional performance measures. Divisional performance measures. Just. So let's look at let's look at those now divisional performance measures. Divisional performance measures. The first one is return on investment, also called return on capital employed. Return on investment, also called return on capital employed. So if you are there, we can just have this summary. Then you say it expresses divisional profit as a percentage. It expresses divisional profit as a percentage of assets employed, of assets employed, of assets employed. It expresses divisional profit as a percentage of assets employed. Another point, this will only be the controllable assets. This will be, or will only be the controllable assets by the divisional manager, by the divisional manager, by the divisional manager, by the divisional manager. So in that case, we say we get it by what? We get it by profit divided by capital employed then you multiply by 100%. You convert into percentage form. Now, my good students, sometimes the examiner may tell you using dew point method. Using dew point method. Evaluate the performance of the company based on return on investment, but using what? This method of dew point. Dew point, so that means return on investment will be equal to profit. Profit margin times asset turnover. Asset turnover. So in that case, profit margin from financial management ratios, we get profit margin as what? As profit divided by sales. Because there is a difference between margin and markup. Margin is applied on sales. Markup is applied on cost or cost of sales. So profit margin, I can also write as what? We get it as profit out of sales. Then I multiply with asset turnover. Again, how do you get this asset turnover? Asset turnover is sales divided by assets. So in that case, you can see that sales will cancel with sales. You remain with profit out of assets, which will take you back to this one. It is profit divided by assets or capital employed, one and the same. So under due point, that is how you apply those margins and turnovers. Good, that is number one. Number two is residual income. Residual income. Residual income, you say residual income, you say it is defined as the amount left. It is defined as the amount left. It is defined as the amount left, as the amount left after the farm pays providers of capital, after the farm pays providers of capital, as well as reinvestment, So there's that amount that the company has been left with after they have paid providers of debt capital, reinvestment has taken place, whatever we remain with, that is what we mean as what? Residual income. Good, so that is what we mean as residual income. How do we get? This is we get as net profit minus cost of capital. Cost of capital. And I told you, you must be given the cost of capital. If not given, calculate at your own time. So that's how we get the residual income. The third one is economic value added. Economic value added, which we say is an extension of residual income. Economic value added. Economic value added. So you can say there, like economic value added. This is the profit. This is the profit, and this is the profit, and this is the profit, and in excess of minimum return required, in excess of minimum return, in excess of minimum return, in excess of minimum return required, of minimum return required by contributors of debt and equity, by contributors of debt and equity. It is the minimum return required by contributors of debt and equity. Good, good. Another point, economic value added concept is an extension of residual income, is an extension of residual income, is an extension of residual income measured by incorporating adjustments, to companies' financial performance, to companies' financial performance, to companies' financial performance. Due to distortions introduced by generally accepted accounting principles due to distortions introduced by generally accepted accounting principles, GAAPs, generally accepted accounting principles. And remember, we said that the one of it is what? Is depreciation, amortization, provision for doubtful debts, those items that do not involve movement of cash. Another point, the adjustments are made to the accounting profit. The adjustments are made to the accounting profit. The adjustments are made to the accounting profit, to the accounting profit, in order to replace, in order to replace, in order to replace, in order to replace historical accounting data, in order to replace historical accounting data with a measure that, with a measure that, with a measure that, with a measure that attempts, with a measure that attempts, with a measure that attempts, with a measure that attempts to approximate the company's economic profit, to approximate the company's economic profit, to approximate the company's economic profit and asset value, and asset value, and asset value, and asset value. Lastly, another statement, if you are together, I can see the little left, the little left long time ago. I'm only with Ruth. Another point, the adjustment may result from capitalization. The adjustment may result, the adjustment may result from capitalization, of discretionary expenditures, of discretionary expenditures, such as research and development, training costs, marketing costs, advertising expenditures, etc. etc. Good. Another point. Lastly, these costs covers the period in which this cost covers the period in which this cost covers the period in which this cost will be received. This cost will be received. Covers this cost covers the period in which this cost covers the period in which the cost will be received. So that is it about EVA. We say it's an extension, so it is adjusted, as we say, adjusted profit minus adjusted cost of capital. Like that. So that is all about economic value added. So Ruth, at that point, allow me to stop there so that when we meet in the next meeting, we look at now the computations.
Thank you, Mwalimu, for your time.